Vaccines picked up speed, but are hitting some bumps. Spring fever and more spending is in the air, and all of that's causing markets to continue to defy the pandemic, but diversification still matters. We'll cover that and more in today's Quarterly Context webinar. Welcome to the Quarterly Context webinar for the first quarter of 2021 for friends and clients of the advisory group. I'm Greg Patterson, CEO. For those of you not familiar with the advisory group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal family realm, their fiduciary employee support efforts, and in their communities through their foundations and endowments. To complement the strategic work we do with clients, these Quarterly Context webinars are designed to make economic and other market type information more approachable, high level perspective regarding the economy, markets, and investor behavior patterns to help our personal wealth and institutional clients stay more relaxed by being more informed and make better decisions towards your goals. The first section is mostly high level, but does have some details. Section 2 has some additional charts for those that are interested in details. And we'll try to keep the first section to about 20 minutes or so, and then we'll circulate a video link should you like to view it again or pass it on to someone you think that we can help like we've helped you. And if you have any questions, please submit them to the question box and we'll either address those as we go or possibly towards the end. As always, we like to just pose this question to focus on what matters and what you can control that cross over in that Venn diagram. That is part of the concept of our Goal Discovery Chalkboard as well. So this is a good piece to fold up and put in your pocket every once in a while and jot down things as they change for you to then talk with your advisor about that, and then we will help you with that process. A number of headlines, as always. Markets were not too volatile in the last number of months with some of the bigger news relating to some improved employment numbers. At the same time that the US hit a post-war debt record, the Fed mentioned a few months back and reconfirmed recently that they are easing their 2% inflation target to be more flexible. That means the economy could run a little hot for a while, and that does have potential implications for inflation. And that some of those inflation concerns help push up Treasury yields, which ended up hitting 2% more recently, a little bit under that during the first quarter. And those elements and some of the stimulation we'll talk about in terms of updates have also pushed up the market to some new highs. So there's a summary here of key takeaways. Mention these things as we go along, so won't dwell on this here specifically, but you can peek back at this sometime if you like as a reference. The COVID status continues to be a problem, but improving depending on what part of the world you're in. The vaccine distribution has been slow in some areas, has picked up speed in others, but overall, the slow response since the beginning of COVID in terms of protection mechanisms and then some of the slow distribution, fast vaccine production, but slow distribution initially has allowed time for more variants to come out, and that is increasing infections and risks, and that's something to pay attention to. So that vaccine progress is really valuable and critical, but as a result of the challenges I mentioned, herd immunity is becoming elusive. As part of the deaths related to COVID in the last year or so, and isn't it amazing to think that it's been more than a year since this all really started picking up speed, but those deaths led to the steepest drop in life expectancy of a whole year since World War II. As you can see here, we've shown the different lines when we've had quarterly context. Overall, the world numbers started getting better and are picking up speed, as you can see, in particular in some parts of Europe and in particular South America and certain other parts of the US. But overall, the numbers in the US have improved, as have the numbers in California. And you can see that steep drop in California here, which has led to a higher level of comfort, both in California and in other areas as well, to open up. But of course, if opening up happens faster than vaccines have really caught up with the variants, we could see another spike down the road. The good news is we're past the flu season, so that decreases the chance that that'll be a complicating factor in terms of the regular flu viruses. Let's taking a peek at some of the key economic indicators, but before we get into some of that, a big part of what's going on when we look at market numbers in a little bit has to do with the stimulation and the stimulus that the government has provided, which has really kind of caused the market to be like it's on steroids. Fed rates are still rock bottom at about 0%, 0 to the 0.25 range. And the estimated time the Fed says that rates might go up has been pushed from 2023 out to 2024. The Fed continues to purchase treasuries, a big chunk every month, and to the tune of 70 or 80 billion, and mortgages to the tune of around 40 billion a month, and there's no stop date to that. So that is continued additional stimulation, which is holding rates down, even if rates have picked up a little bit in terms of the market rates. The 1.9 trillion stimulus became law, and there's an additional proposed 2 trillion, but that may get whittled down through negotiations in Washington. And so that 1.9 trillion plus the 2020 stimulus totals 5 trillion in stimulus, and that equates to about 25% of the US GDP. So that's a big injection, and helpful to prevent the economy from going into a even worse downward spiral during the COVID time, but does have other implications in terms of what's sustainable moving forward. That's also led government debt to jump up quite a bit, up about 7 trillion in the last 4 years to over 22 trillion in total. And the budget deficit is also large at about 2.3 trillion expected for 2021, which would be 10% of GDP. And that excludes the $2 trillion stimulus package. So we've got some big numbers, big numbers there. As part of that, you can also see in terms of some of these numbers, unemployment, of course, had a big spike. COVID has come way down, but there's still some pretty big unemployment numbers out there. It's down to about 6% now, with the Fed now projecting at the year end of 2021 that it might be closer to 4.2%. That's that would be a big drop, and even the 6% now is a big drop from the almost 15% April peak, which I think might have been the all-time high. And there are still somewhere between 11 and 12 million unreplaced jobs that were lost during COVID. So unemployment is improving, but still some significant numbers, and there are a number of people who have stopped looking, which is part of why this number has actually come down faster than you might expect. Then if we look at inflation, has been fairly tame, but there are some hints and concerns about that. Overall headline CPI came down from 1.7 to 1.2, going from November to February. That's year-over-year numbers, and so has increased about 0.5%, so still under the Fed's 2% target, but that is a bit of a shift. And with all of this stimulation and the expected additional economic activity as things open up more, there are thoughts and concerns in some camps about inflation picking up speed. Consumer sentiment has improved a bit, as you can see here. Along with that, consumer spending has gone up, but a big chunk of that is from the stimulus checks. Of course, that's helpful, but not as helpful if that isn't replaced by actual spending from an increase in jobs and incomes down the road. Otherwise, it just leads to a spending gap later. So to talk a little bit more about rates, you can see a chart we've shown before where rates are really hovering right around zero, got ratcheted up a little bit, and then in COVID, right back down to near zero. This is essentially a 40-year compression of rates, and even though it's bumpy, it wasn't compressing the whole time, but the overall trend has been a compression in rates, and when rates are coming down, bond prices go up. So as we talked about last quarter, the projections for bonds in the broad U.S. bond market, and for that matter, international bonds, are lower, and that has implications for, of course, returns and portfolios and the importance of diversification. Bonds should still be very valuable when stock markets get tough, but don't expect the same type of bond returns we've had in the last number of decades, because as rates gradually get back to normal, and that's just happened this last quarter, as we'll see in a few minutes, as rates have gone up a little bit, that creates some negative bond returns. You can see that right here with the US bond market with rates inching up, down about 3.5%, international down about 2%. That's unhedged. The stock market, after a number of even stronger quarters, makes these quarterly numbers look a little bit boring in the 2 to 6% range, but even a 2% return is above the projected annualized return. So for a quarter, that would annualize out to a number that's higher than the projection. So a 6% return is actually still very high, historically speaking, for a quarterly return. For the year, look at these big numbers again. This has been quite a run for the markets, and we'll talk more about that as we go along. Enjoy this while it lasts. It might keep pushing further for a while, but at some point it has to level out and get a little bumpier. And part of what's, if we tie this back also to the bigger GDP question, the gross domestic product, the numbers are improving. The market seems to suggest numbers that would suggest higher GDP than the numbers that are actually happening. But the fourth quarter GDP annualized was revised to 4.3, up from 2.8. That was after having a second quarter 2020 of -31 annualized, and then that big initial rebound in the third quarter of up 33% annualized, with so some pretty bumpy numbers there. Of course, the annualization has a big part of that. And now there's some that are there's a survey from the Wall Street Journal that suggests that there's an expectation of about 6% GDP for 2021. However, the Fed is projecting something even a little bit higher than that, around 6.5%. But here's maybe the more interesting part, is that might be followed by a longer, slower recovery for several years through 2025, with lower than average GDP in the mid 2% range. And that includes these numbers of GDP we're talking about include about 1.5% in 2021 and 2022 that would come from the stimulus package. So those are boosted numbers, not really organic numbers per se. So a few things to think about there. If we look at the overall trend of the markets, if we add the COVID market, really more of a hiccup, a huge hiccup than an overall market trend, because the overall line, if you take the global financial crisis through COVID, is way above these other four worst crashes and recoveries, even on an inflation-adjusted basis. And this dotted line here approximates the long-term projected return of about 7%. So in theory, there could and should be some cooling to get back to normal at some point, but that might not be on the immediate horizon. Some interesting numbers here. If we look at the stock markets in terms of small, mid, and large, and value core or blend and growth for the last 10 years, almost a 17% annualized return for large cap growth. That includes a lot of those big tech stocks, some referred to as the FANG stocks, Facebook, Amazon, Netflix, Apple, and so forth, have really been big drivers of return in the market's overall return. However, and growth in general in this column, as you can see, has been stronger than value, and of course, blend or core. More recently, however, after this long-term growth advantage trend, value has been picking up speed, and growth has cooled off quite a bit, and that's in big part due to some pullback from the tech stocks. And then if we look just at the sort of the COVID related period numbers, from the previous peak, those large cap growth numbers have had a big win, but small cap has done even better. So small cap had been trailing and lagging for quite a while, but is picking up speed. And if we look at the market since the low of March 2020, some unbelievable numbers here. Most people don't realize how much the market has risen, and think of how important it is that you've stayed disciplined in your investment approach and not missed out on the having these components built into your diversified portfolio. But small value being the winner of almost 130% in the last year. Just big numbers. So speaking of the large cap growth numbers, if you look at an index or an index fund like the S&P 500, it's really, this is a topic we've talked about before, including some of the FANG stocks, which are really show up here in the top 5 or 6. The index is really dominated by a small number of stocks. 27% of the index is represented, of the market capitalization is represented by that top 10, and a big chunk of that is in the top 5 or 6. And the S&P represents about 80% of the overall market. So there's this small number of stocks is just has a disproportionate portion of the market capitalization of the overall U.S. market. And the reason we mention this is that a lot of those have grown, and have grown even more so during COVID. That's not something that might last forever, but for now, they seem to be in strong positions, but have certainly been volatile, as we talked about in the last slide. It has still made sense to diversify. But for those, if you know people who are entirely passive investors and have heavy exposure primarily or entirely to index funds, that can lead to some excess volatility because it's really driven by some of these tech stocks. And for a long time, there were no tech stocks except for Microsoft in the top 10. And then now it's all essentially tech stocks. And here below, you can see the weight of the top 10 in the S&P over time. It picked up speed just before the dot-com crash. Then it cooled down over time and became more proportional to other markets. And now it's at a higher proportion than ever. And here we're going to see if we can do a little video that you might find interesting that shows how the top 10 have evolved over time. So let's see how this, increase the speed here. You can see, look, IBM at the top, General Electric number 3, an oil company at number 2, and a big number 2. Look at the others, a lot of physical production companies in the next set of group. Now an oil company is the biggest. IBM Tech is dropping off, and IBM gone. Now wait a minute, still a lot of physical production companies. Coca-Cola, whoop, see that one drop off? Whoop, now they're pulling back. General Electric, unbeatable. But wait a minute, Microsoft then takes the lead. Now some other tech firms like Cisco coming in, and then Cisco drops off out of the top 10 entirely. And some financials, still General Electric. IBM came in, came back out. Some financials take place. Google in for the first time, jumping around quite a bit and then back out. Now Google and Apple jumping towards the top group. Apple neck and neck with Exxon. Now Exxon shrinks. Google, Microsoft becoming more dominant again. Amazon, who had heard of that? Amazon picking up speed. And there you have it. Look at the top 10 now. So those are some a really powerful way, just as a reminder, to see that whatever is in the top 10 now, even if people are excited about it, might be there for a while, but things do tend to change over time. And in some cases, who would have thought that Tesla would be in the top 10 with such low earnings? But the market prices in potential, not just current earnings and revenue. But on that point, the idea is that diversification still matters. So even if you know those top 10 are currently fairly dominant, they have valuations that are much higher than the other portion of the S&P, and that tends not to stay that way forever. Right now, valuations of the overall market are at levels that are not seen since roughly 2000. The 2000 was a very different market, however, with a lot of companies like pets.com and others that had no revenue. Now some of the big players have very strong revenue and business models, but still that doesn't mean there can't be volatility. So it's important not to forget other asset classes, and that's part of the message here. That, for example, while the dollar had been weakening, it picked up a little speed in the last quarter. But as an example, when the dollar weakens, something like emerging markets tend to do very well. So as things cycle through, other parts of the portfolio will benefit. And similarly, whereas the US stock market has been much stronger for a number of years relative to international, you can see here in purple, there are periods where international clearly dominated. And so that can trade back and forth as well. So those markets are still defying some gravity. There was volatility in late January based on vaccine distributions. The NASDAQ was down, which is kind of more tech heavy, down over 10% in early March. Some people may not have noticed that. And that kind of relates back to this idea of there being two different Wall Streets, those that are COVID favored versus those that are not. But again, none of those patterns last forever. They tend to revert to the mean. And so it's important to stay focused on your own personal or organizational risk profile and not give up on diversification. So let's take a minute to talk about bonds. The yield curve shifted up again with some of the future inflation expectations. That also is suggestive in general. One of the things that the bond yield curve implies is a stronger economy, but with that, down the line, but with that, oftentimes relates to inflation expectations. So it's some positive sign with a little bit of a mixed bag associated with it. Here, this chart we've added shows the 10-year range of what the yield curve has been. So you can see where we are now relative to what's more normal. So as the rates and yields increase, then that also has a negative impact on bond prices. And so let's talk about that. There's something called duration, a measure you might be familiar with, is a measurement for bonds that implies, even if it's measured in terms of years, for every 1% increase in interest rates, the duration number estimates also the percentage of the decrease or the loss that would occur for a given bond of a given duration. So if we take a couple of examples here for portfolios non-taxable or taxable that the advisory group builds on a custom basis for clients, the bond portion of those portfolios is roughly in the 4.5% range. 4.5 year range duration. So if there were to be a 1% increase in interest rates, which by the way is unlikely that that would happen suddenly. It would likely happen in much more incrementally. But just as an example, a 1% increase in rates would lead to about a 4.5% drop in returns, at least temporarily. And then over time, as higher yielding bonds come into those portfolios, that increases returns, and there's rebalancing that happens within the bond portfolios. Something that's more of a passive bond component, which is, for example, inside a Vanguard target date fund, for a similar stock bond mix, but just the bond portion, because the passive only bonds, index funds tend to have longer durations because they tend to be heavier in long-term government securities because that's the shape of the market. So the duration for a portfolio like that would be about 7. And that means if there were a 1% increase in bonds, in rates, pardon me, that would lead to about a 7% drop in return for that portion of a passive bond portfolio. So just something to keep in mind. It has some implications, and some of it just to be aware for awareness. That doesn't mean, however, that when the stock market drops, it's unlikely that rates would be increasing. So that's when bonds, even if they have some interest rate risk and other kinds of risk, can be very powerful as an anchor to windward and to buoy the portfolios when other parts are dropping. Here in this chart, tiny numbers, you don't need to see it, but this is a -5% line. So over the last 20 years or so, this shows what that negative returns shown here in red are for a diversified bond portfolio are pretty uncommon. So despite the possibility of that rate risk, and an example like that last quarter, what was down, as I mentioned, around 2 to 3+% for global and U.S. bonds over a course of a full year. On average, that is, it's unlikely to have, fairly uncommon to have a negative return. Here, quick mention, the Callan 2021 Defined Contribution Survey came out recently, and is an interesting way to look at how fiduciary thinking and process steps and what the priorities are shift over time. Won't go through all of this. We'll just mention a couple of things. The top area of focus has shifted in this last year to more around governance and fiduciary process. That's something that our clients are quite strong at, given our five-step process that we use. There is continued focus in some areas to make sure that plan fees are reasonable. What the surveys are showing is that primarily relates to record keeping, custody, and investments. And generally, we're helping clients assess that with regular reporting on cost structures for the investments, which are considerably lower than industry averages, and then periodically revisiting record keeping and custody as the plan changes and as the market changes. Another interesting thing for 401ks, a lot of large plans offer what are called managed accounts, but in a number of cases, those are situations where they don't have pre-built portfolios like we tend to build for 401k plans. And one of the disadvantages to managed accounts is that there's an overlay fee that's charged to plan participants, and that can increase the cost, which then relates back to this overall question of plan fees for things that are charged to participants. So while there is a reasonable number of plans that are doing that, the number has decreased a little bit, and is something to be careful about when it can oftentimes be as easily and more cost effectively accomplished through pre-built portfolios, whether they're target risk or target date funds. Also, for those that are wishing they could offer more of a match during COVID, don't feel alone. Many plans have suspended or reduced their match, and a number of them plan to reinstate. There's also, in terms of the financial wellness area, a little bit less of an overall financial wellness focus, according to the study, but still in the sort of the top 10. And the biggest areas within focus for that, for fiduciaries, is in retirement savings, followed by emergency savings and debt management. So we would agree that from our perspective, while the investment structure is very important, getting people to save enough is the single most important driver of their long-term retirement readiness. And then just mention here that there's a relatively new concept called multiple employer plans, where multiple plan or companies might pool together and create or tap into one retirement plan structure. Conceptually interesting. However, a lot of the plans are shying away from that given the expected increase in cost, control problems, or complexity around administration. But not uninteresting conceptually as a theoretical way to create economies of scale. And one more quick piece from this survey. Again, the participation and saving rates and contributions are what the vast majority of the respondents in the survey consider to be their most important success measures. So we would agree that that is the most important area to focus, especially if you have a well-built investment structure that makes it hard for employees to make mistakes. Then really the savings rates and participation are absolutely the biggest driver for retirement readiness. Not a whole lot in terms of rules and regulation for this quarter. A little bit quiet given the administration change in Washington. For personal wealth, for those of you that are business owners or helping run businesses, the American Rescue Plan is the newest version of support for companies. So if you haven't looked into that and your business is struggling, see if you qualify, and that may be helpful. A few quick notes on the retirement plan side. There's an increased focus on cybersecurity, a new guidance about the process for identifying and addressing missing participants in plans that maybe have left the company, but you can't track them down. And the new administration in Washington is reducing the increased scrutiny and tightening of rules around ESG or environment, social, and governance in terms of investments within retirement plans. Not eliminating all the rules, but not enforcing some of the more strict rules that were hinted at during the last administration. Some new blog posts, including that American Rescue Plan, if you want to get a summary of what you might want to think about there. A few other items here to consider. We try to write things that will be helpful to you in different segments of your interest. And as always, we're doing our best to help provide the 5 requirements here: resources, knowledge, time, desire, and discipline. If any of those are missing, outcomes tend to be worse. So that's really the core of our business model, is being that support structure to help bridge that gap from where you are to where you want to be. And as always, please let us know how else we can support you, what we could do better to support you. And we're also very thankful for those that have referred organizations and individuals to us to help us grow. We're not a heavy marketing organization. We're more of a heavy service and client-oriented organization. So we appreciate that as well. So that's the first section. Some of you may wish to bow out. I will keep going for those that want to get a quick review of a few additional charts. Just a reminder of the business cycle here. So still in the recession stage, and each segment or stage of the business cycle tends to benefit or detract from different sectors. But again, everything's cyclical. A few more charts around valuations. If we look, we saw this chart earlier, but some longer term numbers going back here 25 years. You can see the valuations are above average, not at the true peak in some cases, but still here in the US, for example, certainly near the top end. Usually when valuations are near the top end, the following 5 years has a lower than average annualized return. But the markets have defied that for a while now, and we'll see how much longer that defying occurs. For 10-year numbers, again, this shows it breaks out into more subsegments, but in general, you can see the dot is in the upper half and upper end, upper half of the upper end in a lot of cases in terms of valuations. Volatility has picked up a bit, not as high as the COVID period, but really back to more normal levels. So nothing really surprising there. Talked a bit about consumer or the national debt earlier. Some pretty big numbers and big numbers projected here. You can see the household debt service ratio has come down. Some of the stimulus checks and controlled spending during this recession has helped those numbers, and household net worth as a result, with debt going down and the market being so strong, has improved overall net worth, even if there's still quite a number of people without jobs and that are having very slow increases in wages for those that retain their jobs. In terms of the quality thermometer, quality numbers are usually mixed. Green indicates where high quality outperformed and value has done better, whereas certain parts of growth have done less well. In particular, the lower quality stocks within growth have pulled back somewhat in more recent times. In terms of the overall mutual fund industry cash flows, you can see some for 2020, some pretty big numbers were pulled out of the stock market, I think, as people got worried during the COVID sort of temporary crash, but numbers are getting pushed back in now. But an interesting increase, proportionally larger in bonds, and during that 2020, not where a lot of these stock numbers went into those bond categories, right in time for some of this bond volatility now, while the stock market has really continued to shoot up. So as always, our message here is generally don't do what people are doing on this chart, because they're oftentimes chasing returns rather than thinking long-term and being more strategic. Then, as a reminder, this is the 5-step process we use with all of our different client types: analyze, design, formalize, implement, and monitor. And this is the prudent process we utilize to help our clients achieve their goals. This relates specifically to the investments. There's a similar conceptual process that relates to both the planning and for personal wealth clients and institutions. And I won't dwell on this, but for those that you would like to discuss some other time, just a reminder that both personal wealth clients, or the average individual, and institutions on average sometimes make some emotional investment decisions that harm results. So the fact that you are staying the course, you're avoiding becoming one of the statistics here that suggests that letting go of a manager within a portfolio too soon oftentimes harms results more than it helps. And so just a good reminder as a reference. So thank you for joining today. I always enjoy having you with us. I will check in a moment now to see if we have any questions. So thank you again.